Hello, fellow Rebel Capitals. Hope you're well. I'm here with my good buddy, Chris MacIntosh. And over the weekend, as we all know, the United States hit Iran, and now Iran is kind of punching back, but it's very muted. There's a lot going on in the Middle East. We're talking about closing the Straits of, is it Hormuz? Chris?
Hormuz. Yeah.
And, what impact is that going to have on oil? If oil goes up to 120, then how is that going to impact the inflation rate, gas prices in the United States? What does that mean for interest rates, the bond market, what the Fed's going to do? There's a lot to talk about. So there's no better person to discuss this, how it impacts energy, commodities, macro, and asset prices than my good buddy, Chris MacIntosh. So he was nice enough to come on in a rush all the way from New Zealand. So, Chris, welcome back to the show, buddy.
It's good to be back, and it's always a pleasure and fun.
Insanity, dude. The insanity. Talk to me about what's happened over the weekend and how you see this, and using your framework, what does this mean for asset prices, maybe more specifically energy commodities, over the short term and then the long run?
Well, let's start with this. Let's start with what my mandate is, because it's important, like, for people to understand, right? Because you can have this, I could have the same conversation with, gosh, let's say someone like Alex Craner, a buddy of mine, but he's a short-term trend follower.
Yeah.
And so what he's doing in the markets is going to be vastly different to what we're doing. So with all that being said, our mandate, our methodology is a long-term deep value approach to finding asymmetry. Our timeframes stretch 3 to 5 years, and as a consequence, we don't do anything short term. Very, very little. There has to be something significant that we've missed, or that has come about that we weren't anticipating, etc., that would cause us to make any significant change. And what I mean by significant change would be, 20-30% of our portfolio gets changed to some degree.
Right.
So with that being said, all of the things that we're watching, George, are to a large degree entirely predictable. And what I mean by that is we are in this period of time where we're going through cyclical changes. We have a number of cycles that are on top of us. We have the 250-year revolution cycle. We have the monetary cycle, which is due for a change. We have a commodity market cycle. And all of these things have certain probabilities. So when we go and we look at that, I'm going to just share my screen here. The idea here is quite simple. If these things are relatively predictable from a cyclical basis, it's easy enough for us to determine what the sort of asset classes that benefit and those that don't benefit from that is. That doesn't mean that every time it's going to be correct, but it means broadly that our probability is in our favor. And so here I've taken this, and this is actually from Dalio, who talks about this. Ray Dalio, the chairman of Bridgewater, who talks. There's many folks who've talked about this. This is nothing new, but there's a couple of things that are important for us to understand. There's these 4 major components, all of which are critical to the time frame that we're in. The first is that there's a monetary and a credit cycle where nations get into sovereign debt problems, and that's got to be dealt with. Obviously, that's the case in the world today. Second, you have domestic conflict, or what I call internal conflict, and it's unusual insofar as it's not just 2 political parties which disagree with one another. That's normal. That's where those 2 parties essentially fail to come to any sort of agreement, and where discourse changes to the degree that already it has. You've had essentially political assassinations, whether that be via the media, whether it be via the legal system. These are the things that take place. That is exactly what we're watching transpire in the United States, and it's also, to a large degree, what we're watching transpire in the European Union. Third to that is a rising power that's challenging the existing power. And in this instance, of course, we have China, which is now the largest country certainly by purchasing power parity. and that is causing the existing status quo, if you will, a whole lot of heartburn. The fourth is the technological changes that are assisting in disrupting the status quo. Now, on that front, there's a number of things that we could look at which are in that space. One of the obvious ones, of course, is the monetary system and the utilization of blockchain technology. So we've seen this already, where you've got a lot of capital, international capital now that is flowing, not just through blockchain technology and stable coins, but also through the SIP system, Chinese answer to SWIFT, which has actually now superseded SWIFT as well as Visa, despite the fact that that hasn't been noted in the Western media. So you have these technological changes, or the technology that assists in this movement. The other one, of course, is which we won't really get too much into, is artificial intelligence, and that because that's so incredibly broad, it can stretch through into manipulation of media, a whole lot of things. And I don't know enough about that certainly to make any judgment call about it. But certainly there's technologies out there which are disrupting, shall we say, the existing status quo.
Yeah, and with AI could turbocharge number 2 and 3, by the way.
It normally does,
Yeah.
so whatever those changes that take place are, they normally turbocharge that. And it's a little bit like stock markets that get overvalued, George. The changes always happen right on the edges, and that change can be very, very small, but it can cause that tipping point, which is where you have significant change results. So here's just a very quick chart which will highlight kind of the situations that we're finding ourselves. And the reason I point all of this out, and I'm not pointing out Iran and bombing of Gaza or any of these other things, is to highlight the fact that these things that we're watching are part of a larger cycle, debt bubbles, huge wealth gaps. I mean, you've got incredible wealth gaps now to the degree that we've never, certainly in our lifetimes, seen. And just before we hit recall, we were talking about some of the major problems that we see. And one that we agreed on was that the government now owns so much of the market. It's crowded out the private market, which is decimating the middle class.
Not just owns, but is responsible for, in the United States now, the majority of GDP. I mean, I think that it's safe to assume that when you include state and local, the government spending is at or over 50% of GDP.
Yeah, I mean, their technical term, I think, is 35%, but that's bullshit.
That's federal, Chris. That's federal.
Yeah.
When you add state and local, I think you're north of 50.
And then if you add in the sweetheart deals with corporate entities, which is basically fascism, I think you'd far exceed that. So, for example, a company like Palantir, right? I mean, Palantir, which now trades at a 300 multiple or something, fucking ridiculous. Aside from the fact that it's just an evil company, the point is that the entirety of the client base of Palantir is government, right? So you can't really call it a private enterprise. Right. So you have a lot of those sorts of things. It's good old fascism. In any event, all of that is, again, part of this large cycle that we're watching. And so we are deep in the middle of this, and in the time frame that we're in now. Lucky us. So now let's get to the point of what everybody's sort of been asking and worried about, which is the current situation with respect to Iran and the potential of the blocking of the Strait of Hormuz, and who gets dragged in if we do bomb Iran. Pakistan has turned around and said, well, we're going to nuke Israel, and Russia's turned around and said, well, if you fight, is basically that said Iran and Russia are fighting the same common enemy. China's synthetically funding a lot of this, and has built a rail corridor through to Iran and is supplying. So Iran is essentially not cut off. In any event, you've got a whole lot of ramifications, and we could spend all day, pontificating around what, where, if, and how. And what I would say is, well, go back to this, right? Go back to that. That's what matters. We don't know what the ramifications of all this are going to be. What we do know is that we're going to have a whole lot of problems. And in those periods of times where you have problems, let's go and see what typically benefits. So yeah, I just took a quick screenshot of basically a bunch of the sectors which we, with the Rebel Fund, have allocated capital towards. And you'll notice that a whole lot of them are actually in the space that typically benefits in these sorts of times. There's other ones that are a little bit on the edge, like Greece, for example.
I was going to ask you about that one.
And Argentina. So there's, should we call them special cases? I think people are a little bit more familiar with Argentina, partly because I think it was 2-3 years ago I first spoke about Argentina in Orlando at your conference, and obviously since then things have done well, shall we say, for us.
So what's your rationale with the Greek stock market, Chris? I haven't heard a thesis around that lately.
So we started buying Greek equities back in 2024. I can go to the weekly. Yeah, so late 23, 24, we started looking at Greek equities, and it was quite simple. Whole lot of the, you remember when you had the pigs, and everybody was saying that, yeah, going to have Italy. What was called the pigs was Portugal, Italy, Greece,
Spain.
and Spain.
Yeah.
And they all had significant problems with their, basically with their local governments, the blowing out budgets and so on and so forth. Now, in the past, prior to them having the European one currency, they would just basically keep doing this, and then they'd devalue the currency, and we would all have these cheap holidays in Spain and France and Italy. Sorry, Spain and Italy and Greece. It was fantastic. Every time they devalue the currency, with the European Union coming in and the ECB, they don't have the ability, or didn't have the ability, to do that to the same degree, and austerity measures, etc., were implemented on them. And anyway, long story short, you had this incredible pessimism that transpired, and Greece was the worst of the worst, right? Italy and Spain were sort of lesser culprits in that particular setup. And so essentially what happened was investors fled to the degree that you just had these unbelievable valuations. And of course, they did go through some austerity, and Greece is still Greece. It's still, fairly dysfunctional at some level. But buying something that's relatively dysfunctional but is unbelievably cheap compared to other things which are dysfunctional but expensive is still an asymmetric play. And so when you look at the European Union in general, it's dysfunctional, except you have got valuations in the, shall we call them, the favored markets, such as France and Germany, which really don't make a whole lot of sense. And at the same time, we had these valuations in Greek equities, which were significantly different. Yeah, there's a whole lot of other components included in this, George. For example, Greece is the stopping off point largely for Chinese capital and the part of the One Belt, One Road initiative. In any event, so this was something that we looked at some time back. For us, it was about a 5% allocation into our fund. So it's not, it wasn't going to cause any major issues if things didn't go exactly to plan. But so that's where Greece fitted into that. The other ones are quite simple. I mean, people will probably be quite familiar with this. You've got natty gas, you've got offshore oil, you've got ag and fertilizer, which is a synthetic to the natural gas space, because the natural gas component behind fertilizer production is the vast component. At Orlando, I highlighted natural gas as I had to talk about or pick one of the sectors that we were quite bullish on and favorable behind, which we've sort of upped our allocation towards, and that is natural gas. But again, fertilizer is sort of synthetically tied into that, albeit the fact that fertilizer stocks are wild as hell. They're basically like crypto stocks. There is only a few of them around, and they are incredibly volatile, which is fine. That's fine. It just means you take a very small percentage allocation. So the way that we position ourselves is across multiple sectors which have asymmetry, and then within those sectors we will break it down often by market cap and by geography. Because again, if you go back to all of this stuff here, what happens here is incredible volatility, and it is almost inevitable that at some point something that you own is going to get impacted negatively, even where you might have got the broader trend right. And what I mean by that is you could, for example, be long assets in a particular country only to have that country sanctioned, or to have ports shut, or to have something take place which you didn't, some sort of exogenous event which you didn't anticipate, and that can negatively impact that particular company or companies in that space. So the way that we manage that risk is to be diversified. Obviously, it's also to keep our eye on the ball on a geopolitical basis, to attempt to understand the risks that are in play. And I'll talk very briefly about China as well. So,
You know what's interesting? Can you go back to that chart real quick for that there? I almost think China is further to the right. Like they're in their debt bust right now, especially if you look at their real estate market, which was 2 years ago, $60 trillion is the largest asset class in the world. And it was just
that
nothing but
massively
pure leverage.
deflated. Yeah.
And, you know, I was with Brent Johnson this weekend, and he was doing a presentation at a conference where I was speaking, and he was talking about their current levels of debt right around, it was 60 trillion or so. And I think he's probably including, parts of the private sector in there along with their government debt. But their overall GDP in dollar terms is like 18 trillion, something like that. So their debt bubble and now their debt bust is absolutely massive, and maybe bigger. In fact, probably bigger than what we saw during 2009 and 2008 in the United States. So I almost think they're in that phase a little further to the right, and it seems like the United States, especially when you consider what we've done since 2008, has gone from the printing money and credit phase down into the revolutions and wars phase. I mean, it just seems like we've kind of, this chart would have been more applicable like 5 years ago, unfortunately. Like now we're like 5 years into the future, and we're moving further to the right with China and the United States.
Yeah. No, you're. It's interesting because China has, it's got a sort of a different political, well, certainly a different political setup, and they've gone about attempting to deflate a lot of that real estate bubble, which they've been in the process of doing, and it's had a negative impact, obviously, but they're still going through that, and now they're being met with, you see, because a lot of that was sort of synthetically, well, not synthetically propped up, but it was propped up by their exports, which have continued to grow, and now that's all in jeopardy for sure, because you've got what is almost certainly a global recession, and basically overcapacity. So they're in.
What they're trying to do is prop it up through quote unquote stimulus, which never stimulates anything.
Which gets into their printing and money and credit sort of cycle of things.
That's my point. Yeah. So and I think the United States is probably past that, although it's part of the process.
It's part of the process. It's still in there.
It seems like they've moved down a couple notches, unfortunately, into the revolution and wars.
Well, what the United States basically, broadly, this is oversimplifying things, but essentially they've destroyed their industrial base, and outsourced it, and they have retention of the monetary system and retention of the military system. And so it's like when when you got a hammer, everything looks like a nail, right? And so there's those are the two elements which they have immense control over, and they're incredibly powerful. So the monetary system, they've attempted to, well, they're not attempted to, they have weaponized it, right? Um, both at a domestic level against, by the way, their own individuals, people like you and I, debanking and political censorship and so on and so forth. But certainly on an international basis, they're weaponizing the monetary system. The other component, of course, that they have is a bloated, massive military, and so those are the two components that they've actually used to um, to weaponize. The other is that, well, we could argue that the two of those have allowed for their economic system to maintain itself, and that in itself, Donald Trump tried to weaponize with the tariffs, which I would say he broadly failed with. So it's not that surprising that he would move from tariffs to conflict.
Yeah.
But just on the China, so we got China tech there. China, so this is we've got a little interesting story behind this, but essentially, if you go back and this is predictive of how we allocate capital. So we are, because we're relatively small. In other words, we're not like Vanguard or BlackRock or something running billions and billions of dollars of AUM. We could get easily to $1 billion in our fund, and not change technique or strategy at all.
Right.
That's important because there's our competitors in the world don't and can't do that. Much of the capital over the last 40 years has been aggregated into what I call passive capital, right? So that's your ETFs, it's your pension funds, it's all these capital allocators who are essentially compensated on a fee basis, which is not a performance basis. So the strategy as a business model has moved from one of, instead of um, charging performance fees, to saying we'll just charge you 85 basis points or 1 basis point on an ETF or on some fund, and we'll plonk you into that particular fund and just get as much capital as you can. In other words, run 5-10 billion dollars in that particular fund, and it's very profitable, and you spend a whole lot of money on marketing on the front end, and everybody at the back end who's the GPs and that lives on golf courses and flies around in jets. It's all good. That's been the business model. And what's happened is that the capital that gets allocated to the smaller portions of the market has gone away, which is where we live. That's important because there is an inability for these funds to invest into the kind of things that we do. In other words, we could take $1 billion market cap company or $2 billion and we can buy it. We're not going to move it, right? We got
Right.
like a couple of $100 million. We're not going to do anything to that company. But if you've got 10 billion, you can't go and do that. You can't even take a half a point position in that company. So they don't. So they leave it alone. The reason I point out that and give you that little story is because if you go back and you look at Chinese tech, which got absolutely smashed in 2023, I think it was, there was this increased rhetoric and threat in the market that America might sanction China like they sanctioned Russia. And so all of those big funds that were invested into China, guess what they bought? Well, they bought all these large cap companies like Alibaba and Tencent and so on and so forth. All the Chinese tech stocks, because they wanted tech exposure, number one. And number two, they could actually buy them because they're large enough market caps. Those got absolutely decimated and sold off on the basis of a tariff sanctioning type structure. Now, we're not sitting here saying that we won't have tariffs or sanctions on China. But if we do, the market had already priced them. So when we saw that, we had a look at, started digging through a bunch of these companies, and we just made the judgment call that we had to buy them because they're so cheap. And again, position sizing it to the degree that we've only got a few points in that sector means that we can take asymmetric risk. We can take risk. The market's already priced the risk that there'll be tariff sanctions, and if it turns out that that's incorrect, we'll benefit. If it turns out that it's correct, we are not risking all of our capital on that. So that, again, sort of slight little divergence, if you will, from the sort of macro theme, but those are the other things that we look at.
But it seems like also that it's very non-correlated.
It's very non-correlated. And just on that Chinese thing, so we got a dividend portfolio, which we don't talk much about at all. In that dividend portfolio, we had about a 30% exposure to, I'll call it Chinese stocks, but a lot of them are stocks traded in Hong Kong. These are just deep value companies spitting out double-digit dividend yields with very low or no debt. When that sell-off in Chinese stocks took place, these things didn't move at all. They just trucked on and they did really well. Why? Because if you don't own something, you can't sell it. So when all the big, large, vanguards of the world sold off on the China scare, those particular companies didn't sell off at all. So you've got basically a sector within the market that has a dynamic behind it, which changes the risk profile to it.
Right.
And so we build our portfolios to the degree that we can with those sorts of dynamics, such that you basically don't, we hope, get run over. And you're right, we've got massive diversification. I mean, even if we go into, drillers or gold and silver or any of these other things, we are cognizant of making sure that we are investing basically across the globe.
Yeah.
That's just a quick return profile, so we haven't done too bad. On the right is just the
So you're the blue, Chris, your performance,
yeah.
and what's the green?
So the green's are all country world index.
Okay.
But we've beaten S&P, and so on the right there is just the country allocation. Some of that's actually a little bit skewed, only insofar as you can have, for example, a company that you've bought and it could trade, say, on the New York Stock Exchange, but it might be a shipping company, which is like, well, it's not really a US company per se. Anyway, so that's the dividend. We won't talk about that one because that's not part of the Rebel Fund. Okay. Yeah. Here's, everyone's concerned about all of these geopolitical risks in Iran and everything else. Again, it's you don't want to. The worst thing I think that you could do as an investor is always to be emotional. You don't want to be emotional. So how do you not be emotional? How do you not read these headlines and go, "Oh my God, I've got to quickly do this, or I've got to quickly do that," and run around like a headless chicken making changes which are essentially going to be emotional. They're emotional because you've now got a piece of information that that's concerning you, and inevitably you're going to make some emotional decision. It's almost always a bad idea. So that's where we're at. We've got all of these topics here, which I just wanted to highlight, because if you look at any one of them, they're emotive, right?
Yeah. So just for people that might be listening to this on the podcast, the current headlines that Chris has highlighted: Trump, where he was talking about nobody knows what I'm going to do. That was prior to, I think, him bombing, but I guess you could argue that still nobody really knows what he's going to do. Tanker rates double as ship owners avoid Strait of Hormuz. And I think that even if they're not, the insurance goes up substantially. So even if they don't,
they won't be insured. Typically, what happens, George, is the insurers will not insure them if they travel a particular route. So they can do it, but they're just taking on significant risk. Of course, and then their board will sit there and say, "No, we're not going to, traverse that particular area, because if we lose a ship, it's, I don't know, $60, $100 million, whatever it is, depending on the ship that they're sending through." and their shareholders will be pretty pissed if they make that judgment call. So
Yeah.
they just avoid it.
So then we got Goldman saying the geopolitical risk could add $10 to oil. We got a lot of noise in the price right now, up to 80 last night. Today I saw it was down to 68. But to your point, since all these cycles are almost structural, for lack of a better word, if it's not one thing today, it might be something else tomorrow. Iran Israel clash shakes markets. What's next for oil and inflation? I mean, that goes back to energy oil. Then I would also add that goes back to nominal wages, and that goes back to the banking system. That goes back to the monetary system, because what we've seen in the past is if you do have oil really spike, say up to 120, 130, everyone thinks that's going to be inflationary as far as consumer prices. And over the short run, it might, but then you also have to juxtapose that with demand destruction, because if you don't have nominal wages going up at the same rate, then you're going to get a lot of demand destruction, not just with oil, but with all the other goods, let's say, that oil is an input of. And so I always say you're robbing Peter to pay Paul. And then just as a reminder, during 2008, the price of oil went up to $130 a barrel. The CPI was going up temporarily, but that, you could argue, was the straw that broke the camel's back and took the CPI from 5.6 in the summer of 2008 down to zero about about 2 or 3 months later, because of that demand destruction. And you couple that demand destruction with what was happening in housing, mortgages, and then the interconnectivity of the bank's balance sheets and the insurers, and we know the rest of the story. So it's not as straightforward, and I think that's why you've got a question mark there, which I think is very appropriate. Most people just think higher oil prices, higher prices in general, but that's kind of a timing issue and a degree issue as well. So insurance prices for the Straits of Hormuz, we just talked about that. Erdogan, let's touch on that. The leader of Turkey backs Iranian response to Israel. But what I thought was also interesting is how Putin really backed out of this. And he made it pretty clear that he doesn't want anything to do with it. And the excuse that he gave is because there's 2 million, I think he was saying like 2 million Russians in Israel that are speaking Russian. He's like, it's almost their second language, Russian. So he's like, this goes into our decision-making process as to whether or not to back Iran, and that they're in a clash with a country where there's 2 million of us. And then you go back to kind of the oil price speculation as the uncertainty increases, not just with tariffs, but with Trump's response and continued response to whatever Iran does.
I mean, I think the key thing here is that we're going to wake up tomorrow, we're going to have a new set of headlines, right?
Yeah, right.
And then the next day, we're going to have another new set of headlines. So if you're going to try and build a portfolio and run your portfolio based on the daily headlines, you're going to lose your mind. Like you've got to have a plan.
Yeah.
And so all of these things that we're looking at, yeah, if you go all the way back, like, yeah, this is what we're seeing. This is part of the cycle. It's part of the process. So don't get too caught up in the comments of the day. They're important. I'm not saying they're not important, but they're important for you to assimilate that information and say, okay, where are we at in the trend? Has anything changed that would significantly change, or would, to any degree, change the allocations that I've got? And if so, to what degree? And that's all. That's the only thing you need to do. And most of the time, what we're doing is we're waking up in the morning and we're looking at these. We're asking ourselves that question, and generally we're doing nothing. There's nothing to do. We go, okay, well, all of these things. Yeah, like, do you want to be short oil? No. Okay, fine. Are we short oil? No. Okay, next. Do you know what I mean? Like, we're long tanker stocks. Oh, okay. Well, do tanker rates double? Well, if they do, that's not bad. We'll make a bunch of money. Okay, fine. Nothing to do. Move on. So, and it's not like we bought tanker stocks because we thought the Strait of Hormuz would shut. This is just icing on the cake if it happens.
Right.
We bought tanker stocks because they're unbelievably cheap, because the ability to bring new tankers and ships into the market is massively curtailed as a consequence of the supply destruction over the last 20 odd years in that space, and the inability to finance ships because of the woke agenda and the net zero and all this garbage, and the fact that the entire sector went through a wave of bankruptcies where your debt holders became equity holders, and so just a typical cyclical industry. That's why we bought them. Then we say, okay, well, what are some of the things that benefit in times of geopolitical conflict? Well, guess what? Tanker stocks do. Oh, well, look at that. So we've got one setup where you've got these stocks which are very, very cheap by any measure, and you buy them anyways. Two, you've got a geopolitical setup which would typically favor them. So you go, oh, that's another tick in the box. So now we just buy them and we just own them. We just choose what that percentage allocation should be, and then you watch the proceedings. But it's not like we're running around going, "Oh my gosh, they said they're going to shut the Strait of Hormuz. Quick, buy tanker stocks." It's not
Yeah.
like that. It's not. It's buying your straw hats in the winter.
Yeah.
So it's just like some of the stuff which I threw together, which is the sort of sectors that we own. So if you want to know what like large oil rigs and
What are those things in the upper right? Is that deep sea drilling?
yeah.
Huh.
So that's your offshore drilling, and that's an entire industry. I mean, so we own geomapping companies. We've got pipeline manufacturers who will do the subsea services and things like that. Again, when you start digging in these sectors that have been absolutely decimated, you'll find throughout that supply chain certain companies which are just no one's been looking at them, right? Because everybody's been looking at the wind and solar and unicorn farts and everything else that we've been promised is going to run energy in the world. So we find a huge amount of value within the sort of supply chain, if you will, of that. Bottom one is nuclear. It's got a picture of the Pantheon for Greece. The middle one there is actually palm oil. There's another whole little story behind that, but again, that ties into agriculture. And palm oil, by the way, is found in everything. It's like it's ubiquitous. Gold, we all know about. Which is for electricity. There we've got data center demand, and actually, we had a call yesterday. I think it was with one of our clients, and he works in data center in, I think it's Toronto. And it's absolutely true. The demand coming in from AI for data centers, and so all of like essentially, if you're going to make a judgment call as to who's going to win AI, and there's that's a big sort of debate at the present time. One could argue that that the answer to that lies in cheap electricity generation, because it is the biggest cost component. So second cost component is cooling. And guess how they cool this stuff? Well, with more electricity, of course.
Energy.
And that ties into the chart on the right and the chart on the bottom, nuclear, which is the cheapest form of mass electricity generation.
Chris, why do you have gold and silver? Why not one or the other?
Oh, we've got, well, it was just a picture. I mean, we own gold and silver.
Yeah, but why? Why not own just one or the other? Isn't that too correlated?
Because there's part of it for me is and I learned this lesson years ago from one of the brokers that worked for Rick Rule, and it was to try and he always said keep it simple. Silver has benefits to it. Certainly, it's more of an industrial metal. One could argue that it's not necessarily a monetary metal. We own a lot less of it, but essentially, that sector, precious metals, if you go through these cyclical periods of time and monetary regime changes and so on and so forth, it always benefits. To what degree is speculation at this point in time. Personally, if it was like if you said you got to go out and buy something, I just buy gold. I wouldn't necessarily get into silver. Central banks don't own silver. Gold is the thing that they buy. Even your large corporates, institutional money, never really gets that interested in silver. It's mostly retail. And so I think that's much more late stage cycle stuff. But we own a very small, I think about 1% in it,
Okay.
for diversification. Platinum's the other one. Platinum, which is very, very cheap now, is actually, there is a supply deficit within platinum. So we've got a couple of companies in that space, which just more recently we've picked up. And um, and of course, platinum is much more rare than either gold or silver. And then on the left, we've got coal and good old Argentina with Mila and his chainsaw there. It's got its own little special story. We don't have to cover that because we've spent quite a bit of time on it. But essentially, Argentina is sort of on the bucking the trend. It's on the other end, if you will, of the spectrum of debt and leverage and economic decline, if you will. Certainly, the bureaucracy side of things, which has stifled the country for 40 plus years, is being chainsawed away as we speak. And as a consequence, we're seeing stabilization in the currency and stabilization in the credit markets and credit coming back in, and a whole raft of very, very, very positive things. Time will tell if that continues to be the case, but certainly it is looking very positive at this point in time. And despite the fact that we're up, gosh, sort of 10 times or something on some of our positions, if you still look at the valuations of a lot of these companies, they are still very cheap. And the amount of capital that has come into Argentina is still minuscule. FDI is less than 3%, and most of the influx of capital is actually Argentines who are bringing capital home, which is a good sign. So anyway, that's the Argentine story. And this is just if you think that you're sort of overweight some of these sectors, or those sort of things you've missed the boat, so to speak. And we get that question sometimes because we've done relatively well, and people go, "Oh, have I missed the boat?" Well, we think not. Certainly, globally, investors are not in largely allocated toward this. In fact, I just got back from a few weeks back from Cayman Islands. We had an event there, and I had a chart there which showed family office allocations towards certain sectors. And now family offices aren't typically distinctly different to institutional money. And in the family office space, George, you had allocations to emerging markets was 1%, allocations towards commodities was under 1%, and allocations to precious metals was 2%.
Yeah. Wow.
I mean, just it was all growth, tech, Nvidia, Meta, and then family offices typically will also own certain portions of private equity, and in the private equity space, it was corporate real estate, which we'll know what that well, that's your buddy Ken McElroy's space. It's just percentage of allocation towards mining equities. Again, you go back to all these, like the cyclical period that we're in, and we know what typically benefits in these times. So we think we're still relatively low. Here's your interest rate cycle going back 5,000 years. So keep in mind, of course, that interest rates can stay low, but you can just keep distorting the economy, which is kind of what we're seeing, right? We were just talking about this before, but it does have ramifications on allocations of capital. So commodities markets, and that's it really. So that was our little share for the day, if you will, of how we're looking at just Iran, for example. But you could call me up in a month's time and there'll be something else, right? Maybe
There'll be something else, but your framework will still be the same.
The framework will be, and there might be some
structural.
There might be some changes that we need to make, but essentially, it's not like we're rebuilding a cake.
Yeah, exactly.
Yeah.
So, guys, if you didn't know, I have a fund with Chris. Chris is the money manager. He just comes on every once in a while and lets me know what he's doing. But if you want to check that out, it's glenarchycapital.net/rebel-fund. And this gives you kind of some information on it. Chris just basically went over the portfolio right there and kind of the rationale for the portfolio. But if you want more information on it, you can just go over to this website, and I think you just hit get started and then send that over to the guys. And I think you can go ahead and book a phone call with Chris himself and just ask more questions and see if this is something that might be right for you.
Yeah, it'll go through to booking a call, and what you get is a calendar. Essentially, you book a call, and Brad and I will jump on, and we'll just answer any questions that you've got, tell you what we can do, what we can't do, and look forward to having a chat.
Yeah, fantastic. All right, buddy. Thanks for coming on with
It's been a pleasure, as
short
always.
notice. Hopefully things settle down in the Middle East. But to your point, we're living in a time with likely a lot of volatility. So we'll have to just keep paying attention and see what happens throughout the rest of this week.
Well, when you say hopefully they hopefully they settle down, Brad sits down and goes, "Come on, have a go." It'll be good for the portfolio. Half joking, of course, but yeah, it is what it's. We'll get what we get, but again, you can't make judgment calls based on the headlines of the day. That's just not a very good way to run any portfolio, in my opinion.
Yeah, I think that's the main takeaway from the interview. All right, buddy. Have a good one. We'll talk to you soon.
All the best. Take care.